Before buying insurance, do not start with the product name, the premium discount, or the most attractive illustration. Start with a more basic question. What specific risk are you trying to transfer? If that question is not clear, insurance can easily turn from a risk management tool into an expensive form of emotional comfort. Comfort is not worthless, but comfort should not be confused with financial protection. The core job of insurance is not to predict the future. It is to transfer a loss that the household cannot reasonably absorb on its own. The buyer is not asking whether a bad event will definitely happen. The buyer is asking, if it happens, would the household cash flow, debt plan, caregiving responsibility, or family stability be damaged beyond what savings can handle? That question makes insurance decisions more practical and less emotional. The first axis is probability. Some losses are common but relatively small. A phone breaks, a minor medical bill appears, an appliance needs replacement, or income is slightly uneven for a month. These events may be unpleasant, but many households can handle them with emergency savings and spending adjustments. Other losses are less frequent but far more severe. The main income earner dies, becomes disabled, faces a major illness, creates a liability event, or needs long-term care. The difference is not fear. The difference is whether the loss can break the household plan. The second axis is financial damage. Many people compare policies by premium first, but they never estimate the size of the actual gap. If a family spends a large amount each year on essential living costs, still has a mortgage, and depends on one major income, then the loss of that income is not a small inconvenience. It may require several years of cash flow support. A cheap policy that covers only a few months of expenses may feel useful, but it may not transfer the real risk. When probability and damage are put together, a simple risk map appears. High probability and low damage events usually belong to savings and budgeting. Low probability and high damage events are the classic insurance zone. High probability and high damage problems may require lifestyle, work, health, or balance. Sheet change before a policy can help. Low probability and low damage items may provide comfort, but they do not always deserve years of premiums. Insurance is better for large, rare, and unaffordable shocks. If a household has no basic emergency reserve but commits too much money to long-term policies with high surrender costs, the order may be wrong. Protection should not create a new liquidity problem. The fourth question is whether the buyer is purchasing protection or an investment wrapper. Many policies combine death benefit, medical protection, savings value, dividends, market exposure, return of premium features, or tax stories. A combined product is not automatically bad, but it can make comparison difficult. Separate the functions. How much of the premium buys pure protection? How much builds cash value? How much pays for fees, riders, commissions, or investment management? How much is guaranteed and how much is only projected? A useful method is function separation. The first layer is the protection function: death, medical, disability, long-term care, liability, or property loss. The second layer is the cash flow function. Does the policy pay a lump sum, reimburse expenses, replace income, or provide ongoing support? The third layer is the savings or investment function. Does the policy have cash value, surrender costs, market risk, credited rates, or non-guaranteed projections? Once the layers are separate, the buyer can see what is actually being purchased. The coverage gap should be calculated from household responsibility, not from a sales slogan. How many years of essential spending would need support? Should a mortgage or major debt be covered? Are education costs, caregiving costs, or spouse retirement needs part of the responsibility? What existing assets, workplace benefits, social insurance, and current policies already reduce the gap? The remaining unaffordable gap is the part that may deserve risk transfer. Many buyers are attracted to return of premium features because they do not want premiums to feel wasted. That feeling is understandable, but it can be misleading. The value of insurance is not that every dollar must come back. The value is that a manageable premium can create a much larger protection amount for a severe event. If a return feature makes the premium so high that the buyer cannot afford enough coverage, the product may feel efficient while the actual risk transfer becomes weaker. Another common confusion is using insurance as forced saving discipline. Some people know they struggle to save, so a long-term policy feels like a commitment device. That can have behavioral value, but it should be named honestly. It is behavior management, not automatically the best investment structure. The buyer still needs to examine liquidity, surrender charges, fee transparency, realistic returns, and whether premiums become dangerous if income falls. Timing matters. A young family with dependents and limited assets may need low-cost, high-protection risk transfer before complex savings products. The first priority is to protect against a large hole that the household cannot fill. Later, when emergency reserves, investments, income stability, and basic protection are stronger, more complex planning for estate, tax, long-term care, or legacy goals may become relevant. Starting with complexity can leave savings, protection, and investing all underfunded. Policy terms matter more than the feeling of safety. Waiting periods, exclusions, renewability, premium increases, reimbursement definitions, disability definitions, long-term care triggers, claim limits, and coordination with other benefits can change the real value of coverage. Two policies may sound similar in conversation but behave differently in a claim. Insurance is not just the word protection. It is a contract with conditions. The buyer should also check for duplicate coverage. Some duplication is reasonable because different policies may solve different gaps. But buying many small overlapping benefits can become expensive without increasing real protection. The question is not how many policies you own. The question is whether the household risk map still has uncovered holes. If there is no hole in a certain area, extra premium may be better used for emergency savings, debt reduction, or long-term investing. Premiums must fit the household budget. A policy that cannot be sustained during a moderate income decline may add risk instead of reducing it. If income falls by 30%, can the policy still be paid? If family spending rises, does the premium crowd out emergency savings or essential bills? If the answer is no, the buyer may need a simpler structure, different coverage amount, or shorter commitment. Investment-linked insurance deserves a separate lens. It is not automatically wrong, but it must pass two tests. First, does the protection work efficiently? Second, is the investment component transparent, flexible, and consistent with the household's asset allocation? If the fees are layered, the investment options duplicate existing holdings, the surrender rules are restrictive, or the projections are too optimistic, the word investment should not make the policy feel safer. A strong insurance plan is often less glamorous than the sales presentation. It identifies the household's largest unaffordable risks, transfers the right part of those risks at a sustainable cost, and leaves the rest of the financial system to other tools. Emergency savings, debt management, investment allocation, legal documents, and family communication all matter. A 5-step check can make the decision clearer. First, list household responsibilities, who depends on the income, and what debts or care obligations exist. Second, estimate the largest financial gap if the event happens. Third, list existing resources, cash reserves, workplace benefits, social insurance, current policies, and investable assets. Fourth, decide which remaining gap is too large to self-insure. Fifth, compare policy costs, terms, exclusions, and sustainability against that specific gap. If someone recommends a policy, ask 4 questions before discussing features. What exact risk does this policy solve? If I do not buy it, what is the worst-case dollar gap? Is there a cheaper or more direct way to solve the same gap? If the investment or return of premium wrapper were removed, would the protection still be efficient? These questions do not attack insurance. They put insurance back in its proper job. This content is educational commentary, not insurance, investment, tax, or legal advice. Real decisions depend on local rules, policy terms, health status, income stability, debt, family responsibility, existing coverage, and personal risk tolerance. A useful first step is to draw your own risk map and place each policy next to the gap it is meant to cover. If a policy cannot be placed next to a specific gap, it may be comfort rather than risk transfer. One more guardrail helps prevent overinsurance. Treat premiums as part of a household safety budget. That budget must serve emergency reserves, essential protection, debt management, and long-term investing at the same time. The safest household is not the one that buys a policy for every fear. It is the household that assigns the right tool to each risk: cash for small shocks, insurance for unaffordable shocks, investments for long-term goals, and legal planning for family responsibilities. Once the tools are separated, the insurance conversation becomes calmer. You do not need to buy because of fear of missing out, and you do not need to reject all coverage because premiums feel unpleasant. Ask who is hurt, how deep the loss is, how long cash is needed, what existing resources already cover, and what remaining gap is too large to keep. Those 5 answers are the beginning of insurance planning. A practical evidence ladder can prevent emotional buying. The first step is household spending evidence: housing, food, debt payments, medical costs, insurance premiums, education support, and caregiving obligations. The second step is income evidence: salary, bonus, business income, spouse income, rental income, or other reliable cash flow. The third step is existing protection evidence: workplace benefits, social insurance, emergency savings, current policies, and assets that can be used without destroying a long-term plan. Only after those 3 steps should the remaining gap be treated as a candidate for insurance. Without this ladder, a buyer may purchase duplicate comfort while the real gap stays open. Scenario testing also helps. A base scenario might ask what happens if income stops for 6 months. A stress scenario might ask what happens if income stops for 3 to 5 years while debt and family obligations continue. An extreme scenario might ask what happens after death, permanent disability, or long-term care. Each scenario may need a different tool. A short interruption may be solved by cash reserves and spending cuts. A permanent household income gap may require a larger transfer mechanism. The point is not to dramatize every fear. The point is to match each tool to the size and duration of the cash flow hole. Policy evidence should be written in a comparison table. List the insured event, claim definition, waiting period, exclusions, renewability, premium adjustment risk, surrender costs, cash value, and the remaining household gap after a claim. This table forces every attractive feature to answer one question: does it actually reduce the gap? If the feature sounds comforting but does not change the household's ability to survive the bad event, it should not consume too much of the safety budget. Communication is part of the protection. Beneficiaries should be current. Family members should know where the policies are, what documents are needed, who pays the premium, and which coverage must be preserved first if income falls. A policy hidden in a drawer may not work when the household is under stress. Good insurance planning should make the next step clearer for the family, not only make the buyer feel calmer on the day of purchase.